Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hour show. It is great to be here with you. Now, remember, the most important thing of the show is what's on your mind. So if you have a question, leave the ticker symbol and your question in the comments. We'll go over it live during the show. Doesn't matter what I have to talk about. Your comments, your questions are most important. All right, so the markets, they took another leg down today. The S&P 500, it hasn't finished this low since June 18th of 2021. And oil has spiked, meaning everything is about to get more expensive, way more than it is right now. This is just the beginning. Sunday evening, oil went up to $130 a barrel. Yes, $130 a barrel. And we were just talking about not too long ago, like 2 weeks ago, and it was under 90. Wow, what a difference, right? So we're going to talk about that. Also, Palantir got upgraded today. Some good news on that. So we'll talk about that. It also leaves a nice upside with their price target. And activist investor Ryan Cohen, he bought a large enough stake in Bed Bath & Beyond to mix things up a bit. So we'll talk about that as well. I've got a deep dive on my thoughts on Bed Bath & Beyond and Ryan Cohen and what's going on there. So we'll talk about that too. But remember, like I said at the very beginning, the most important thing is your questions. What's on your mind? If you have a question, I'll say it one more time. Leave the ticker symbol and your question in the comments, and we will go over it live during the show. All right, ladies and gentlemen, let's start with the market, right? Investors remain concerned about the ripple effects of the Russia-Ukraine situation and an accompanying increase in oil prices up to, well, I think it ended today about $119 a barrel, up about 3.5% on the day. It was up way more than that, like 12% Sunday evening. But the S&P 500, it dropped 3%. And before I get into the other numbers, just real quick, it was almost like today, the entire world economy, all the different indexes and the different countries, they all sank today. I don't think there were any that were actually up in green today. So S&P 500 down 3%. The NASDAQ hit underperformed big time, dropping 3.6%, while the Dow Jones, it lost 700 points and was down 2.4%. The Russell 2000 fell 2.5%. So investors also continue to assess stagflation risk to the global economy, with everybody pulling out of Russia and isolating the country, not just Putin, but the citizens too. Everyone is going to be hurt. There will be a recession coming to Russia in the months ahead. Maybe 12 months from now is when all the sanctions that have been put into place will hit Russia all at once, real hard, and it won't be good for the country. So I do feel sad for everyone in Ukraine, for what's happening, for Russia's aggression. But I also do feel sorry for the people of Russia. They didn't ask for this, right? So we have to have compassion here for the citizens on both sides. Of course, what Putin is doing, history will judge him. Okay, so as this escalation continues with the war in Ukraine, it's pushing commodity prices to record highs. Record highs. That means everything is going to become more expensive. You think because of, the supply chain constraints that we've had here recently over the past year, it seems like, have caused things to just go up and inflation to go up. Just wait. Everything will be going higher. I'm not sure if the Fed really has anything left in the toolbox that it can use. It can't, lower rates because rates are already near zero. So they've got a big problem on their hands. Also, the military conflict has created economic uncertainty, and investors, they grew concerned that it could hamper central banks' ability to loosen monetary policy, like I just said, to provide any type of support. So it's a real tough problem that they have right now. And the war is just making it worse. Now, the session today, it actually started on a flattish note, overcoming a 2% drop in the market for futures. But you can see here, I mean, it ended down 2.95%. So it was just right on down all day long, right at the opening bell. But there was a period this morning, and look, this is the S&P 500 chart here in front of you. Let's go to the 5-minute part of this, and we'll check out this morning right quick. So you can see a bit of buying frenzy right here. The last 15 minutes of the day is always higher volume. I mean, you can see that it goes back days and days and days, right? It's been doing this all year long. The last 15 minutes, it's either a big dump of selling or it's a bunch of orders being put through to buy. So today, we actually got a bunch of a high volume bar here, higher than normal, of buys coming into the market, right? And it actually caused the blue line all the way down here with the volume bars to increase like it does normally when this occurs, because of that. But if I put this line up here inside the yellow box, it's hard to see. It's just a little dotted line. It's higher than the past 2 closes that we've had, past 3 closes, and we have to go back 4 closes to get this type of volume. But that was 4 sessions ago selling at high volumes. This was high buying at the volume, right? The last 5 minutes of the close. Okay, so if we go look at this morning, you can see there was about a 30-minute area right here this morning when the market first opened. It's like, we're unsure about this. Are we going to go lower, or are people going to rush in and buy the dip on this one? And people did not rush in to buy the dip on this one, and it fell 30 minutes after the open. Then it just sunk, right? And then we got to this area right here, from about, let's call this the lunchtime hour, right? From about 12:30 all the way until 2:30. Yeah, 2:30. It was kind of flat, and it's kind of interesting. The lunchtime hour almost every single day from about 12 o'clock to 2 o'clock. A lot of times that's when the market can kind of flatten out for the day. I find that there is definitely a pattern. Volume definitely picks up after the 2 o'clock hour, after everyone's back from lunch, and then the bosses can say, okay, do this or that, right? So we did have this little balancing session right here in the middle of the day, lunchtime hour, where it was kind of flat. It didn't really go down. It was just, kind of totter, going back and forth. And then we hit right there, 215, and we fell hard into the close, right? And we actually dipped below this yellow box here at the close. Let me get volume out of the way so we can see it better. Give me a quick second to adjust this. All right, so this last, it's really tough because that volume candle is really high up there. So that last say 30 minutes of the day right there, we actually dipped below 4,200. Okay, that's what this yellow box is right here. It is 4,300 to 4,200. So we dipped below 4,200 in the S&P 500 today, and that's a pretty big low, right? We haven't seen it since June 18th of 2021, right? So it's been several months since the S&P 500 has been this low. It did close up a little bit higher because it was 4201 was the close for the S&P 500. So it just barely got back above it, and that was the last 5 minutes of buying here. That big volume candle there of buying put it back into the yellow box for the close. But we got as low today. Let's go back to the daily chart here, and then I gotta fix the chart right quick. It's gonna look funky. There we go. All right, so we got as low today on the S&P 500, which is the broadest view of the market, 41.99. 41.99. That's how low intraday, and that was right before the close. Last 5 minutes, it dipped that low, and then it pulled back up to close at 42.01, down 2.95% today. So if we look at where that is, there's actually a blue line here, okay, and it's sitting right at 4,200. And if we go back and look, and this is where we figure out, how long ago was it that we were, last at this position. So we follow this blue line all the way back, and we get right here to June 18th. It was a red day. The S&P 500 was down 1.3%. It took it to the 50-day moving average, which it bounced off of back there, or back then. And it actually closed, let's see here, at 41.66. So that was the last time we were this low in the S&P 500, going back to June 18th, 2021. Now, where are we going next, right? Because I've got these two arrows, a green one and a red one, and they're coming off of this vertical line right here. This vertical line is March the 16th, right? March the 16th is a very important day because that's when the Fed will come out with their press release, I guess around 2 or 2:30ish, and then Jerome Powell will come out and he'll give his speech about what they're doing. And we know that rates are going to go up by 25 basis points, and it's going to start in March. So we know that much. How is the market going to react to this? Well, there's a couple of wild cards, I'll say, that are out there, that are still out there. And these wild cards are what's happening in Russia and Ukraine. That's a really big wild card. And that wild card is what drove the markets down today. And that wild card is what pushed oil up so high. And when oil goes up, everything becomes more expensive because oil goes into making the world work, right? It's what greases the gears that keep the world spinning and grinding every single day. So, since it touches so many different things, everything's going up in price. We can't help it at this point. 6 months from now, it is going to be so much worse as far as pricing goes. Inflation is going to be worse than it is now, and the Fed is just lacking the tools, I believe, to really handle this. So, since we have some certainty of what the Fed is likely to do, then the markets are liable to kind of seesaw here. At least Friday, my thesis was that the market would seesaw from where it was then, somewhere between 43 to 4200 up to a lid of about 4400, and this is the S&P 500, and it'll just back and forth until we get to March 16th. And then the Fed comes out and it says what we expect them to, the 25 basis point hike happening in March. Quantitative tightening is happening, QT instead of QE, or I'm sorry, my apologies. And then the market may actually flip and start to rally after that because we have a piece of the puzzle, right? It's no longer uncertain what the Fed's going to do. We know because they've come out and said it now on March the 16th, that is. So the market could turn and begin to rally because that one piece of uncertainty is now certain. But we still have that wild card of Ukraine and Russia to deal with. And since prices of everything are going to go up, that's also going to affect next earnings cycle. And the earnings cycle after that. And the earnings cycle after that, right? The rest of this year, you can expect companies to come in and report costs were higher, margins were smaller, and the share price is going to go down. I can see it playing out right now. We've seen this before in history, right? And I know history doesn't repeat, but history definitely rhymes. All right, so just a little bit of extra uh, uh, extra thoughts there I didn't expect to talk about. Okay, back to what I was talking about, oil. That's what led me down this rabbit hole. Now, it initially spiked to $130 a barrel, which was up 12% on Sunday evening, and when futures came out, they were also down. Now, that was catalyzed, right? Catalyzed by the news that the US and its allies were discussing a ban on oil imports from Russia. You think gas prices are high at $130 a barrel? If that embargo actually took place and America and all of her allies blocked Russian oil, that embargo would lead to oil prices much higher than they are today. Yes, they would. Okay, now the retracement, it also coincided with news that the foreign ministers of Russia and Ukraine agreed to meet on Thursday, and that Germany was holding a softer stance regarding the ban proposal. See, Germany gets a lot of their energy from Russia. So they don't want to piss Russia off by too much, right? They can go along with what the allies and the US are saying to a certain degree, but they're not going to come out and be heavy-handed against Russia. No, 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 not Germany. God forbid that happening. They might get their energy shut off. Then what would they do? Well, if the US was more energy independent, we could supply that to Germany. We could supply that to Europe and then really put the screws in on Putin and what he's doing. But the US has become less energy independent, and we need to stop that. We need to cut it out, okay? Everybody knows how the world works. We know how the gears turn, and we need to do it. We can't just turn the switch off on oil because it's bad for the environment and flip the switch on for alternative energy. We can't do that. We can't flip the switches at the exact same time. It has to be a slow, easy process. And I know that may upset some people, but it's the gosh darn truth. Okay? You can't just turn oil off completely and turn solar or wind on 100% because the world isn't set up to run on anything other than fossil fuels. Now, that doesn't mean we can't get there. And I'm on board with getting there. I do believe we should be alternative energy. We should be able to use natural, recurring, renewing energy and not have to dig it up from the ground. I'm a firm believer in that. But we can't just flip the switches 100% right now. Okay? It has to be an easing into it process. All right? You don't just throw a saddle on a horse and then hop on it and ride off into the sunset. No, that horse has to be trained. It has to be trained to accept the saddle. I mean, you just can't hop on a horse and go. The same thing applies with our energy situation. We have to take it slow and easy and eventually over time transition. Okay? So I hope I didn't make anyone too mad on that, but it's just how the world is right now. And it's how the world has been, but we can change it and go to a better place. And I'm behind you for doing it. All right? Okay, good. All right, now the fact that prices were high was or also compounded concerns about a slowdown in consumer spending due to people having to spend more at the gas pump. And we know that that is true. When people have to spend more money on gas, they do less. They go less places. They stay local. They don't travel. They don't get to spend their money on a vacation because maybe all of that money went towards filling up the gas tank going back and forth to work. So we already know that there was a slowdown coming to the economy. Now, with what's happening with these gas prices, the economies are going to, all across the world, are going to slow down at a much faster rate. And that's where that word recession comes in, or stagflation comes in, which, of course, we don't want to see either one of those. But when prices of everything continue to rise, the economy doesn't do so good. Now, the weak price momentum in stocks was another cause for concern with investors today. Now, the underperformance of the S&P 500 consumer discretionary sector, which fell 4.8%, corroborated the consumer slowdown narrative. It just backed it right up. Likewise, the US Global JETS ETF, ticker symbol is JETS, JETS, that fell 11% today because people will not be getting on planes to travel places because the airline ticket will be too much. It'll cost too much because jet fuel will be going up as well. Everything is affected by this. It's unfortunate, but it's the world we're in right now. All right. Uber, ticker symbol UBER, it fell 4% despite raising its Q1 adjusted EBITDA guidance range. So not too bad for Uber, but the stock still fell. There was just too much pressure in the market today that brought it down. Now, last week, the mega caps were not a place to hide out, presumably because of cash raising efforts among expectations for further weakness. And we know that weakness is still ahead. Now, you can see this with the Vanguard Mega Cap Growth ETF. The ticker symbol is MGK. Watch that one. It's a gauge. MGK. It fell 4.1% versus the 2.8% decline in the Invesco S&P 500 Equal Weight ETF. Ticker symbol is RSP. Use these ETFs to judge and get a gauge on how the market is doing day to day to day to day. That's what the ETFs are there for, as a gauge for investors. Of course, they're a place that you can invest so you don't have the single stock risk. That's the big thing, right? Okay, now on the upside, some positive news. Of course, the energy sector, it was up 1.6% today. And utilities, of course, because that is a defensive play. Utilities are a safe place to park your money. That was up 1.3% today. Those were the two sectors on top. Now, the former, the energy, was obviously a beneficiary to higher oil prices. The latter, utilities, received support from Next Energy, ticker symbol NEE. Follow this one. This one's interesting. Next Era Energy. Look at the run it had today. 4.95% today. It has fallen, right? It starting on January the 3rd, the very first trading day of the year. It has been on a big decline. Now, Next Era Energy. I'm going to scroll down here on the right-hand side, and I want to tell you something here about it right quick. So, it's an electric power and energy infrastructure company, all right? It operates through the following segments: the FPL and NEER. Now, the FPL segment engages primarily in the generation, transmission, distribution, and sale of electric energy in Florida. The NEER, that segment, produces electricity from clean and renewable sources, including wind and solar. It provides full energy and capacity requirements services. engages in power and gas marketing and trading activities, participates in natural gas production and pipeline infrastructure development, and owns a retail electricity provider. Of course, the company was founded in 1984. Okay, did you hear that part? Alternative energy, wind, solar. Next Era Energy is a company you can get behind for its next era, its next generation energy. It is a awesome company. It's a cool one, and it's one that you can get behind in this transition away from oil and towards alternative energy. Okay? Just remember, we can't do it overnight. It will take time to do it. And I know that can be frustrating at sometimes, but we have to be logical about this. We have to be sensible about this. David, how's it going? You can't grease an axle with solar. Very good point. People will be rebelling with high oil prices. Another great point. Not enough income to pay all the bills. Another great point. All three of those things I said about 15 minutes ago. Big money is heavily into investments in oil. Another great point, David. A sudden drop in oil, severe contraction in money, severe recession, government interfere with our money supply, digital dollars. You can't pay the gardener with credit cards. One heck of a mess. You are absolutely correct. I said almost all of those things except for the government part about 15 minutes ago, talking about this whole energy crisis that we're in right now. We can't go from a world that is completely run by oil and energy of that sort, especially a lot coming out of Russia at this point, and then expect to go completely green in the flip of a switch. Those two switches can't flip at the same time. It'll take time to transition, and that transition, I mean, it could take a century for that transition to occur. Definitely several decades at the very least. Maybe a millennium. Who knows how long the transition is going to take, but the transition has started. I do believe that. I think so. But it will take time. And that's why I point out Next Era Energy here as something that you could get behind for alternatives. They do have a little dividend, 2.12%. I don't know if they have any stock repurchase program going on right now or not. But if we look here at how the stock has been performing, big sell-off at the beginning of the year, and it's been a very choppy ride going back to March of 2020. Very choppy ride, but it has been getting higher, at least until the last trading day of last year before its big sell-off occurred. But it's definitely something that you can get behind with higher oil prices to help at least, have your stocks appreciate instead of going down and seeing red all the time. But one thing I'd be careful of with this recent rally that it's been on, it is showing strength. It's above its 50-day moving average, which is a very positive and bullish sign. Maybe there might be a pullback or two, but then again, this one's running on pure momentum right now with the past 3 sessions of this thing just going up and up. So it may be best to wait for a cooling off period or a pullback. But with that wild card of how things are happening, I'm not sure if we're going to get much of a pullback or not. Let's see. How much of a pullback could we buy so as not to buy on FOMO, fear of missing out? So this 200-day moving average, and it's a simple 200-day moving average, that right now is sitting at $81.15. I believe when it was sold down here and it had a big sell down because of earnings, big gap down here, I think that sell down was overdone. I think the selling was just too much. It was emotion and just sold it down. If you're getting under that 200-day moving average as an entry point, I think you're doing a good job. Because if we look back in history on this, and I know history can't prove what it's going to do in the future, but it has a lot of reactions around that 200-day moving average. If we look, let me get the my little highlighter tool out here. If we look back here in September, October time period, it reacted, bounced off of that 200-day. Here, it used it as resistance, but hugged that 200-day right here. And that's going back to May, June of 2021. And then again, here we had another W pattern here, a double bottom right around that 200-day moving average where it bumped off of. And again, I mean, look right here, going back to the March of 2020 and April, May. I mean, it really just bounced off of that 200-day. So if you can get it for under that 200-day moving average, that to me is a good entry point. And again, right now that's sitting at $81.15. So sub $80, and I think it's a good pullback based on how the stock has been reacting. And even if we go back before March of 2020, you can see that simple day 200-day moving average right along here. It always bounced off of and again bounced off of. So it's a good indicator to use for an entry point for this particular stock. Next Era Energy. I might have missed out was the price increase on high volume. Oh, let me go right here and open this up a little bit further and see how it was reacting. All right, there we go. Okay, clear that up a little bit. All right, so volume here, when it made this almost like it tends to make this W shape, right? It did it here in October timeframe 21 and March timeframe of 2021 also. And it kind of does it here too. It's got this double bottom right here. Volume is elevated on this move. So that's an indication that this is a fair oversold bottom here for the stock. And if we go back and look at this last time this W pattern occurred, the double bottom, volume was elevated, not to the extent that it is right now or that it was when those two bottoms occurred. And if we go back again to this third double bottom pattern right here, you can see that volume was also elevated. But after that elevation, volume cools down, but the stock still rallies. And it typically will go up to a high above 73 on the RSI before it has any pullback. And this one is 89 on the RSI before the pullback. And this last one here would be 69 before the pullback. So right now the RSI is at a 68. So again, if it's sub that 200-day moving average, that's when I would look for entry point. So you might have missed it for just this moment, because if we take out today's move, which would be this 4.95%, when it closed on Friday, it was below that 200-day moving average, which would have been still a fair place to purchase. And volume had already started to cool off a little bit come Friday, and RSI was starting to level off at a local high of about 58 or so. But of course, today it just shot up because of the news in Russia. So that's Next Era Energy. I wanted to put that on everyone's radar. It's a good alternative company providing alternative energy, but it still also provides traditional energy. It's a good combination of the two as we transition to that. So keep that one on your radar. And again, sub the 200-day moving average has worked for the past 3 years or more, maybe about 4 years now in a row. If you get in sub 200-day moving average, you're getting in at the lowest of that typically goes, right? Of course, this low that it has made here, this double bottom, first on January, what would this be? The 24th. And then again here on February 24th. Those two bottoms were the lowest that it's been. And you have to go all the way back to May of 2021 to find that. So again, sub 200-day moving average, simple day moving average is a good entry point. And that's that. Hopefully that answers your question. Thank you for sharing those thoughts, David. I greatly appreciate it. And glad you're here. Really am. Okay. Moving on. Oh, one more thing about Next Era Energy. It was upgraded today, and that was part of why it really kicked into gear and pushed back above its 200-day moving average. It was upgraded to overweight from sector weight from key bank capital markets on the view that the company will benefit from increased clean energy initiatives. And I think that is true across the board. All right. Treasury yields also finished on a higher note today, and that was a byproduct of cash raising efforts as demand for treasuries decreased, right? The 2-year yield increased by 5 basis points to 1.54%, and the 10-year yield increased 3 basis points to 1.75%. Now, on today's economic data that we got, it showed that consumer credit increased by $6.8 billion in January. Now, that was a noticeable deceleration in credit expansion in January from December, right? And it was mainly attributed to Omicron issues and rising interest rates. Those are the two things that really came into play for that happening. Now, revolving credit saw its first contraction since April of 2021. So that's not looking too good again for the narrative of consumer spending. That is definitely going down. And it will continue all year long. Higher prices, less consumer spending. It's a no-brainer. Okay, here's where we stand year to date. The Dow Jones, it is now down 9.7% year to date. So it is just about in correction territory. All right, there we go. I just want to get up here on the chart real quick to show you its pattern and its fall here. There we go. Let our lines load there. So we had this bottom here for the Dow Jones, which is 30 stocks, on February the 24th. We did not get that candle wick that low or even a candle that low to close. But what we did get today that is similar to February the 24th was today's close. If we look, the close on February the 24th for the Dow Jones was 33,223. And then today it closed at 32,817. So we got about 500-point difference there in the closes for those 2 days, February 24th, and then again today. About 500 points higher today than on February the 24th, right? Okay, so that is interesting. 500-point difference there between the bottoms of the candles for both days. Now, I think the Dow is going to hang out in this space right here. A low somewhere around 32,290 and maybe a top somewhere around 34,000 even. All right, let's call it there. Nice easy number to remember. So 32,290 as the bottom, and then 34,000 as the top for the Dow Jones. And you can see the decline that it's been on. It's making lower lows and lower highs. So we can draw this trend line right here, okay? And if we draw this trend line out like that, we can see we got lower high, a lower high, and a lower high. So that then, if we do get a rally here, that's going to put us right around 34,000. When we tap that rally, if a rally were to occur, that it would tap that resistance line there, and it would slow things down. Now, we don't have much here, but if we went from this low to this point here to that point there, this is not a trend line mark here, but I'm just doing this to show you that we are making lower lows. So we have December 17th as that low, and then we have this low on January the 24th, and then this low on February the 24th. So we are making lower lows. We're in a downtrend, and it is down now 9.7% year to date. Now, the S&P 500, let's put that one back up. It is now in correction territory. Let's see here. Both of your moving averages are moving down. Should we wait for a golden cross over to be safe to buy again? No, you don't have to wait for a golden cross, because the death cross and golden cross, they are lagging indicators typically, meaning that the trend reversal has already occurred, and you're already into either a downtrend or an uptrend when those two things occur. So a golden cross, for example, means that we've already bottomed out and we're trending up now, and that's what's bringing the longer term 200-day moving average up higher to cross with the 50-day moving average. Or I'm sorry, I got that backwards. Sorry about that. But it's when the 50-day moving average is coming up higher, right? And the 200-day moving average is kind of slowing down, but it's a lagging indicator. That's just the point I want to get across. So it is something that you can wait for, but typically if you're waiting for that, you're missing out on some gains, or you're adding up extra losses if you wait for a death cross or golden cross to occur. To give you an example here, on the S&P 500, let's look at this right quick. So we are making lower highs. We can line it up right here, and I'll take it right there. So we can start here at January the 4th, the second trading day of the year. That was the high. And then we have another, a lower high on January the 13th. And then we have a lower high here, even though it's up above our trend line here just a little bit, because there's a price line resistance right here. So it broke the trend line by a couple points right here, but it is a lower high. And again, that was on February 9th. And then we have a lower high right here on March the 3rd. Now, it is possible that we reverse out of this yellow box if we get some kind of good news overnight, or If something changes with the wild card of Russia and Ukraine, or if oil prices for some reason temporarily come down, then we could get a small rally and this be kind of a local bottom. But then, if we did get that rally, that would probably put us on this resistance line, right? This downtrend that we have here, right at the FOMC meeting when Jerome Powell is to give his remarks and state whether it's a 25 basis point hike that begins now and whether it's, other measures are going to take effect and they're going to remain smooth-lined, or they're going to be more hawkish or more dovish, right? So, okay, that's the top line. Now, on the bottom line here, what it could say is if we start with this low here on December 20th, we could definitely say this was a lower low, and over here was a lower low as well. So you can see it is a defined downtrend. So what we want to see for a reversal of this, instead of waiting on the golden cross, is we want to see a rally start to form, number one, and we want to see volume spike on that rally, okay? So maybe we get a 2 or 3 day rally and volume is just, typical, right? That does not mean that this trend is reversing, because if we look right here, this local bottom on our way down back here at the end of January, right? It stopped, it reversed, and we got a 4-day rally out of that. But if we look at the volume here, right, we had a declining volume. Volume was going down. That meant this was not a reversal in trend, okay? Because volume was going down. If you don't have enough momentum, you're not breaking and reversing a trend. So we have to see momentum rising, which means volume is rising at the same time that we have a rally. Then you know that we could be reversing, and that would be obviously before the golden cross would occur. So if we look here at this little rally that we had here, not much, but it was a rally nevertheless. If we look at the volume line here, the average, it moved straight across, maybe slightly to the upside, but it was pretty much, let me line it up there again. It was pretty much flat, okay? That meant this rally, this was not a trend reversal. This was just a short-term rally. If we want to see that long-term rally reversal, we want to see volume increasing as the rally is occurring, because that gives you the strength then to break through the resistance and then get to your golden cross. Okay, so that's a couple things there on the S&P 500. All right. All right, so S&P 500 down 11.9% year to date. That puts it in correction territory, because remember, 10% and below, that is a technical correction. 20% and below, that's a technical bear market for a stock or indice. All right, good. Thank you. Good job. Okay, thanks, David. Greatly appreciate that. Okay, other one. Russell 2000's in third place. It's down 13.1%. And then the NASDAQ, that's the big loser here. That thing is down 18% now year to date. It is just about two percentage points away from being in a technical bear market for tech stocks, right? Unfortunately, I don't think, maybe short term after the FOMC meeting is done and over with, and we have a little more clarity on what the Fed is doing, maybe we could get a short-term rally in tech, but it's not likely to hold for the long term. I do believe it would be a short-term rally. For example, we get good news on March 16th. We know what the Fed's doing. We have a little clarity on that. We still have the wild card of Russia, Ukraine, but we have clarity now on the Fed. I could see a rally in tech, but it would be a short-term rally, maybe lasting a few weeks, maybe a few months, but it wouldn't last. Uh, it wouldn't last for the rest of the year. Definitely not, because there's too much price pressure right now. Consumer spending is going down. The economy is slowing down. And that's never good news, especially for the technology sector. Okay, let's move on now. I wanted to talk about gold for just a moment because, it's going up. GOLD on TradingView, and you want to go with the TVC as the data source for this. And this is in US dollars to ounces, like gold is typically reported. You can see this massive run up in gold, and it's broken through a couple barriers, like the 1900 area. That was a barrier for a long time. It acted as resistance there for gold, but once it broke through that, it was just off to the races. It has pulled back from that $2,000 level, and that's a big, big psychological level for gold. Gold is up 9.2% year to date, so it's performing better than the indices are. And if we scrunch up the chart here to look at it over a longer period of time, to get back to this point that we're above $2,000 an ounce, we've got to go all the way back to August of 2020. That's when it was coming down from $2,000 an ounce. And the beginning of August of 2020, that's when it spiked up above the $2,000 an ounce. And then by the middle of August, it started coming back down. And then it started its downtrend all the way to a reversal, I would say, here in the end of May of 2021 is when it finally made its reversal and started marching higher. Now, where could it go from here? Well, if uncertainty continues, I mean, look at gold right here. Over the long term, it has been trending up, at least going back to this point here, September of 2018, right? September of 2018, going back even further than that, December 2016, going back even further, 2015, gold was kind of moving sideways, and there wasn't much movement at all in gold. But then if we go further back from 2015, kind of being the bottom there, August through December 2015, that was kind of a bottom before it started moving sideways. But then back here, and this would be September of 2011. We all know what happened in September of 2011. And back here, that's when it got to a high, but it didn't break. It did not break $2,000 an ounce. It got close. Now, if you call 1770, 1827, that's about as high as it got. And again, that was back in September 2011. And that was its peak for then. And then it fell. Well, it was rallying from there, but it fell from that point all the way to 2015. So gold goes through these big, long cycles. And you can see this going up to 2011. This was a big rally for gold. But I mean, I'm back at 06 now, and we're nowhere near $2,000 an ounce, right? Right here, this is 2002, and we're at about $325 an ounce. We are going way back in history. Uh, and then here we go. This is August of 1999, or 1999. Uh, and we're at $256 an ounce. And that was a bottom of 1999, uh, where it finally reversed and it went higher. But I mean, you see, we got to go way, way back in history to even find anything remotely close to $2,000 an ounce, right? Even here with this rally, here we are back in 1987, and we're at about $500 an ounce for gold. So, gold's got a long history, a long, long history. And I guess the point that I'm just trying to make here is that uh, you can have you can have uh, gold at $2,000 an ounce, but things can turn around really quickly with it. So gold is something that I would not buy during times of fear. You kind of want to get a hold of gold before those times of fear. Uh, so, for example, and I know hindsight is 2020, but at the very least, if after March of 2020 occurred, right? That would have been a good time to buy because that was before all the fear set in and gold ran up in price. But after that, as it was coming down in this very defined channel, once it broke, and this right here is, what would this date be? This would be the 31st of March 2021 when it had this double bottom right here for gold. That was its reversal sign that it was heading higher. And you could have picked gold up, let's just say somewhere between 1690 and 1750, right? That still would have been a uh, nice rise in your price of gold there, going up to $2,000 an ounce. But the point I'm just trying to make, I feel like I'm just talking a lot here, going back in history, but the point is, you got to be kind of ahead of the game when you're thinking about commodities like gold. You don't want to buy them when everybody is rushing to the door to buy gold. That's not the time to buy, because then you're buying at the top. And I'm not saying that this is the top for gold. Gold could go much higher. If the economy got 10 times worse than it is right now, gold could probably be 10 times higher than it is right now. I don't know. I don't have a crystal ball, but I'm just saying we have to be very cautious, and we have to be very aware of our surroundings if we're going to get pulled into commodities and buying gold or silver, or even going into cryptocurrency and buying Bitcoin and Ethereum or Cardano or something like that. So just be careful. Don't buy at the top. And I know we don't have crystal balls. We can't predict it. So just be careful with that. And I guess that was a lot of rambling to just say, be careful with gold. I guess that's it. Okay, before we get into my deep dive here, um, uh, your question, what was before the tech collapse? Are you talking about the 2000 bubble for tech? Is that what you're talking about? A little more clarity on that question, and I'll be happy to jump into it. Are you talking about technology sector as okay. So let's pull up the NASDAQ here. All right, come on. All right. Yes, it was a local bottom in 1999 and 2000, and that was on gold. Um, uh, oh, I understand your question now. So before the tech collapse in gold, the chart, um, when tech had its bubble burst in 2000, that was a bottom for gold because people were risk on in the market, and there's a very common pattern to how the Nasdaq has been performing right now to how it performed in 1999 and 2000. And let me pull up. This is a weekly chart here of the Nasdaq. And if we go back and look, the big V right here, this is 2020, okay? And then we go back further here. Yeah, I'll go way back. This was another tech bubble right here, and this was 2007. That was a tech bubble. And when you have these risk on in the market, technology is going to go up, gold's going to go down. When it's risk off in the market, technology is going to go down and gold's going to go up. They have an inverse relationship, gold versus technology, an inverse relationship. And it looks like right now, for some reason, it's only going back to 2003. There must be a glitch here on this. Okay, I can do that. All right. All right, I'm gonna go back to a daily chart. And then I'm gonna add in here. No, that's not right. Oh yeah, I think that is right. Okay. So here we have the NASDAQ are your candles, right? The orange line is gold. So when, oh, hold on, let me get this lined up here right quick. All right. So with this inverse relationship with gold, when tech is rallying, and I'll freeze it right there. When tech is in a rally, gold is going down, and it's not 100% in the same percentage amounts, but you can see this right here. If I put this trend line on the peaks of gold there, those two peaks are heading down. I got to stop on that one. And then we can catch this peak, and this was a bottom on tech when gold made that peak. And we can go across like that because those three peaks line up. Now, if we put vertical lines here, I'm just going to start right here on this one. A vertical line. When gold reached its top right here, that's when technology, and if we look back up at the top here, that's when technology had made its reversal, and it was now moving higher and in a rally. So while gold then declined, right, technology was in a rally, okay? And you can find that all over this map. Of course, most recently is the biggest divergence. Gold is going way up while technology is going way down, right? Big inverse there. And then we can also use this one right here. Gold reached its peak. Let's find it right here. And then it went down. And then from that peak on gold, then technology rallied. And then gold kind of moved sideways right along here, while tech then continued to rally. What? Oh, okay. There we go. And then tech rallied while gold moved sideways. And all along this line right here, gold's making a lower low, lower low, lower low, while technology, higher low, higher low. While gold is going down, technology is going up. And then there was this one time right here, this would be 2021, where gold rallied. Oh, come on. There we go. Gold rallied, and then technology also during that same time, it rallied really hard up, and then it moved sideways, and then it came down during this rally in gold, right? So we can start to see the inverse relationship between gold and technology. This our first one that we made here. Then our second line here for gold, when it was going up, tech kind of went up, plateaued, and then came down. And then here, gold is going down. Our third mark there on gold. Tech is going up. And then we have a gold is going down while tech goes up. And then gold is moving sideways, tech's going up. And then lastly, where we are right now, where gold is going up and tech is going down. So you have that inverse relationship with gold and technology. And it has right now is one of the biggest divergence gold and technology has had. And you would think, though, because gold is used in a lot of technology itself. So the manufacturing of technology is going to use gold, and maybe there's a correlation that you could probably make with manufacturing in gold. I haven't thought about doing that before, but maybe that's one I'll write down here and look into. Just a loose anti-correlation, maybe fear plus recession. That's a good point. That's a real good point. I like that one. Okay, let's see here. Writing down, looking for manufacturing of technology and uh, gold usage plus gold price. I'm gonna have to research that one. All right. Okay. Let's move off of this one. Let's see if I can't. Before I do, clean up the chart a little. And then next, I'm going to talk about Palantir for just a quick moment. And then I'm going to do my deep dive on Bed Bath & Beyond. All right, there we go. Oh, take those two lines off right quick. All right. PLTR is the ticker symbol for Palantir. Now, Palantir is interesting. Technology stock, technology company, does work for the government, private sector. It's an interesting one. It's lost a ton of value, but it is $1.03 right now above its direct offering, which was at $10, and that was back in, oh my goodness, way back when. October of 2020 is when they went and did their direct listing. And I bought in at $10 a share and been holding it ever since, ups and downs. But they held up pretty well today. They were up 3.1%. They were up higher, but they came back down. But they were still up for the day. They're down about 0.7% in after hours right now. Now, earnings when they came out, they missed here on EPS. But one of the good things was they're bringing their cost, or the share dilution, you might want to say, or even you could say the share compensation has started to come down. It was reflected in their earnings report. So they missed EPS by 2 cents. They beat revenue by $15.2 million. So not a big miss and not a big beat either. But the reason I'm bringing Palantir up today is because they were upgraded, and that's what really fueled the momentum uh, somewhat in the stock, at least putting it in the green for the day instead of red like everything else. But it was upgraded to equal weight from underweight at Morgan Stanley, and they also lowered their price target, and I suspect that they would have when they did this because of where the stock has gone so far. Right now, the stock is down substantially from where it was, but $16 a share is where they lowered their price target to. And that's still a really decent price target. And if you look on the stock chart here, you can see it. They have this area of support, or they had an area of support for about a month's time, right above 12.50 a share, right? $12.50 a share. And it held up good there until February 17th. And that was right on their earnings. And they gapped down, and they've kind of been using about maybe $11 even is kind of the low end of support. But where it closed today, and I use the after hours number, $11.03 a share, up to $16, that represents a 45% upside from today's closing price and actually today's after hours price. So that's not a bad upside. And if we look just over here above my head, you can see there's an area of support right here at about $17, $18 a share, right around here. So 16, that's an interesting number. There's not a whole lot right here, but if we go back and look on its way up at $16 a share, again, there's not much to look at $16 a share. There's a little bit, maybe November 9th through November 16th, a little area there at about $15 a share. But 16, there's just not a lot of support for it. 16 has marked lows in the past for Palantir. But I'm getting off topic there. Palantir has what I think is an impressive AI software, and it actually has a high, somewhere around a 30% free cash flow margin, and it's got a huge growth runway. And I think the probability of Palantir becoming profitable could take place in the next few quarters. So maybe 3 quarters from now, 5 from now, but I think it's coming. It looks like it on the earnings. The numbers are moving, at least in this last report, in the right direction. So just keep that on your mind there when you're thinking about Palantir. Okay, and investing in Palantir, I wouldn't jump in right now. Really, with this environment, it could go down more. It really could. One thing that's helping to keep it up are retail investors holding this thing. And if you really like the company and you want to invest, I would wait until it reports profitability, then jump in, because then you've actually got something there that you could hold on to by saying that it's profitable. But before then, our current environment is going to wreck any company that is not making a profit. So just keep that in mind. I love the company. Still own shares in it from day one, and hopefully it will become profitable relatively soon. Okay, good. Who is their primary customer? The U.S. government is their primary customer. They mainly have government, but they're, especially this last quarter, consumer customers are growing, but the U.S. government is their sole biggest customer that they have. All right, Bed Bath and Beyond, 3 B's and a Y as the ticker symbol there, BBBY. Now, I'm talking about Bed Bath and Beyond because I think there will be a lot of investors curious about why did Bed Bath and Beyond shoot up so gosh darn high today, and want answers to that. So I'm going to talk about it. Hopefully by the end of this deep dive, you'll have a better understanding of what's happening with Bed Bath & Beyond. Why did it end the day up 34%? And this huge gap up and big candle. I mean, wow. To go back in history here to find the last time that it was up at this price point, we have to go actually right here, August the 25th of 2021, or 27th there, somewhere around there. The end, towards the end of August, 26th maybe, of August of 2021. That was the last time it was anywhere close to this price point. And that's above $20, right? So it's been doing a wild ride. I mean, look at these gap downs and gap ups all over the place. This thing has just been everywhere on the stock chart. There's nothing here. It's just all random movements. But I guess there is some madness to its movements. So Bed Bath & Beyond. The stock took off to the moon today on reports that investment firm RC Ventures disclosed that it now owns about 10% of the home goods retailer, and that the firm wants management to undergo a strategic review. Now, that's not always a bad thing. Sometimes that can be good for a company. But activist investor announced, or activist investors, when they announce that they have taken over or they bought into a large part of a company, this reaction that you see here today from Bed Bath & Beyond, that's not typical. All right. You'll hardly ever see a move like this when there's an announcement made that an activist investor or a large firm has bought into a company at a pretty big stake. All right. Kohl's, that's the name. KSS is their ticker symbol. Macy's, ticker symbol is the letter M. Both of them in recent months, they have found themselves in the crosshair of activist investors, but you have not seen any moves like this where the stock is trying to take off to the moon. And so, just pointing out, this is not a typical response when investors take a large stake in a company and want to change things up, right? So just understand that one point right there. So RC Ventures holds a lot of sway with investors. It's owned by billionaire Ryan Cohen, who is the co-founder of Chewy.com, ticker symbol CHWY. So it holds a lot of credibility, especially with retail investors. Also, RC Ventures is known for being aggressive as a stakeholder. It likes to go in and push the buttons and move things around a bit. So, a few years ago, it took a similar action with GameStop, ticker symbol GME, which now has a new CEO where Mr. Cohen himself now sits as the chairman on the board. Plus, RC Ventures' stake in Bed Bath & Beyond is a large one at nearly 10%, like I said at the beginning. RC Ventures' main concerns are that Bed Bath & Beyond is overpaying its executives, and it's failing to reverse market share losses that they believe have occurred. It wants the retailer to narrow its focus and improve its operations and inventory mix. So maybe more digital. We'll see about that one. The firm also wants Bed Bath & Beyond to undergo a review of strategic alternatives. What does that mean? Well, that could lead to a sale of the entire company, or more likely, a spin-off of its better performing Bye Bye Baby segment. That's more likely. Now, I have to admit that Bed Bath & Beyond has been frustrating over the years, as it has been caught up in like endlessly trying to turn things around. Like, let's turn it around. Let's announce a turnaround. Let's announce we're going to do this or that new strategy, this new initiative, right? Oh boy. In late 2019, it actually hired Target, ticker symbol TGT, executive Mark Tritton as its new CEO. Now, one of the main challenges is that Bed Bath & Beyond has been facing, what should I say? How should I say this? Bed Bath & Beyond, one of their big problems is digital sales, all right? And Amazon has been taking digital shares away from them, okay? They have not been able to nail it in the digital space. And I think it's mainly to do with Amazon. Now, Target has done a pretty good job in in regards to the digital space. So you could have been excited by the new hire, and he has made improvements and changes to the company, but more is needed. A lot more is needed. And those changes that the new CEO for Bed Bath and Beyond, some of them haven't really even taken hold yet. But the clock is ticking on this. So I guess bottom line here on Bed Bath and Beyond, I'm generally fans of seeing activists, investors spur shakeups, right? Because sometimes managements need to be reminded to challenge their assumptions, right? And think outside the box to solve challenges. And sometimes activist inputs, they can light a fire under the executive team to make improvements and make improve and get better performance. So my take here on Bed Bath and Beyond is that its stores are perhaps too big, and maybe they have too many physical stores, and maybe with Mr. Cohen going in, that maybe they'll close some of their stores and maybe take some cash from that and put it into their digital offerings. That's a possibility. Now, I do like that Bed Bath and Beyond has been focusing more on digital sales and on its proprietary brands, because that's where it can really make some money. And on there's a concept that is called a store within a store. It's like if you take a miniature Bed Bath and Beyond and put that into another store. So you see this at Walmart sometimes. You'll go into Walmart and especially around tax season, and you'll see maybe a certain tax company sitting in there, and they can do your taxes right there, right inside of a Walmart. And Walmart has the eyeglass place, and some of those it's Walmart owned. Sometimes it's owned by somebody else. Nail care. So a store within a store concept, it's something that Bed Bath and Beyond has tried with Kroger stores. Kroger, ticker symbol KR. So I do like that concept. It's interesting. Now, I do think that the Bye Bye Baby brand, which has been outperforming the core Bed Bath and Beyond brand, could make sense as a spinoff or a sale candidate. I do like that idea. Now, I don't see a lot of synergies between Bed Bath and Beyond and Bye Bye Baby, right? Maybe there's a little mix or crossover with some of the baby furniture or sheets and bedding type of stuff, but not a whole lot of anything else. So a sale could generate cash for Bed Bath and Beyond to put it towards going digital or more digital. So it's always difficult to predict what an activist investor will push and what they'll be able to achieve. So sometimes they go nowhere, but I highly doubt with the influence that Mr. Cohen has that it's going to go nowhere. Uh, it'll at least result in some type of compromise to get something changed and something improved, I think. But I I do think that for smart institutional investors uh, to prod management from time to time, it always leads to improvements, better performance, and it's always a nice sign that management is getting challenged again. So that's a good thing. Well, that's my quick thoughts there on Bed Bath and Beyond. But what do you think? Do you think that Mr. Cohen coming in to shake things up is a good idea and what they need? And what do you think about Bye Bye Baby? Do you think that should be uh, separated, maybe IPO'd and go off on its own with Bed Bath and Beyond being like the parent company? Maybe that could work, or just a complete flat out sale of it to somebody else and just cut that loose, take the cash and focus on achieving something, whatever that something may be. All right. So I'll go ahead and wrap it up here. for today. I want to thank you so very much for being here with me. If you are watching the replay, go ahead and leave a question, ticker symbol in the comments. We'll go over it live during tomorrow's show. Yeah, time will tell for sure. Absolutely. Absolutely, it will. If you could, three things very helpful. Clicking the like button that lets YouTube know you found this video to be helpful, informative, actionable. Taking the URL, sharing it wherever you can. That also lets other people know that you found this video to be helpful, informative, actionable. And click that first link in the description or that first link in the live chat and consider looking into one of those. Uh, Everyone so far has commented back that they are very helpful. So maybe they can be helpful to you. They definitely give guidance on where to be in the market, what are the best places to be in. Yeah, just consider doing that for me. That would be very helpful. Helps out my work, research, and everything else that we do. All right. So thank you guys so very much for being here with me today. I greatly appreciate it. And I'll see you in the next video. Goodbye.